Inside the MBA, your bi-weekly window into what's happening at the MBA.
Hi, I'm Rob Van Raphorst. Welcome to MBA Now. 2018 has seen a lot of changes for the mortgage industry, with limited housing inventory, rising interest rates, and new regulatory relief legislation all impacting the marketplace. And a recent proposal from the White House about the future of the GSEs could fundamentally reshape the secondary mortgage market. With that in mind, Pete Mills, MBA Senior Vice President for Residential Policy, has stopped by to give us an overview of MBA's policy priorities going forward and how they could benefit MBA members in this changing environment. Pete, thanks for being here.
Thanks for having me, Rob.
Pete, can you first sort of talk about some of the headwinds you're seeing right now and how our policies sort of intersect with those headwinds?
So in the immediate term, Rob, you touched on it in your opening, higher rates, lower sales volumes, tight inventory. It's an incredibly competitive market and margins are very tight. So profitability in the industry is a very significant challenge. And one of the things that we're working on right now is the loan officer compensation rule. It was put in place in 2014 primarily to deal with steering issues, steering borrowers into higher rate products. What's happened though in the implementation, and particularly in the current market environment, it serves as a barrier, it prohibits lenders from competing on interest rates. So if a borrower is shopping, which is something that the Bureau encourages everybody to do, and gets a lower rate, goes back to their original lender and says, hey, can you lower my rate? Currently, the lender can lower the rate but takes all the cost of lowering the rate. And so the inability to share that, to adjust your single largest variable cost, which is loan officer compensation, the inability to do that makes it hard for lenders to compete. There are other aspects of the rule, holding LOs accountable for mistakes they might make in a file, as well as the ability to participate in bond programs. All things that would improve the market, make it better for consumers, all are limited by the LO comp rule. So we've spent quite a bit of time in our comment letters to the Bureau on the request for information on that particular issue. We actually have a meeting this week with them, and this is probably, of all the calls I get from members every day, this is the single biggest issue in the near term that we're working on.
Let's talk about GSE reform for a second. I know the administration recently put out a proposal on how to deal with Fannie and Freddie. What is your take on everything?
So, I mean, the conventional betting, you read the newspapers, GSE reform is dead, for at least for the remainder of this year, and some people are betting even longer term. I think that's not the way to look at it. First of all, it's the single biggest structural issue that we face as an industry. As you mentioned, the White House has put out a framework for GSE reform, and even if there isn't legislation, we're going to have a new director come January of 2019. And that director can implement reform through the administrative process. So we're engaged on all levels. We were pleased that the outlines of the administration proposal were very much aligned with many of our core principles. But the details matter, and we don't have the details yet. So that's an opportunity for us to engage with the White House and to flesh out the details. But also we're looking at, if Congress isn't able to muster a consensus on GSE reform, looking at ways to accomplish our core goals, but through the administrative process. And so looking at things like, how do you ensure for the long run a level playing field for all participants in the marketplace? How do you build a backstop behind the guarantee using the remainder of the PSPA? So there are a variety of different ways you can go. We're engaged in all of them. And again, to think that GSE reform is sort of dead for now is probably a mistake. Things are moving underneath the ice, whether you can see it or not, and we're going to be involved.
Let's talk about regulations for a second. The President recently signed a reg relief bill. There was a lot of implications in there for our members. Can you talk a little bit about its impact?
Yeah, I mean, the most significant one from our perspective is what we call the transitional authority provision. That's something that's been very important to us. We've been working on it for close to 3 years. And what it does is it allows a loan officer to go from a bank to a non-bank and continue working while they complete their testing and their licensing process. That will take 18 months to implement in some cases. we're pushing for it to move faster. So we think the states can move quicker. We've met with the CSBS on the implementation process, and our goal is to get it implemented much earlier, way ahead of the 18-month, which would be November of 2019. We'd like to see it really moving in a number of states by early to mid next year.
Great. Listen, we really appreciate you stopping by and talking a little bit about the marketplace and an overview of the industry.
Happy to do it.
This is Mortgage News Network.